Hi everyone, this is Meenakshi from BCom IT Department, Dr. SNS Rajalakshmi College of Arts and Science. Today I am going to explain about marginal costing in Final Accounts Interpretation subject. Today we are going to focus only on what do you mean by marginal costing, the significance and the limitations of marginal costing. What do you mean by marginal cost? Before going to learn about the significance, we have to get some idea about what do you mean by marginal cost. Marginal cost is nothing but the overall change happens in the total production cost that comes from making or producing one additional unit. Take it for example, if the manufacturer produces product X of 100 units at the rate of 20 rupees. So the total production cost will be 100 into 20, 2000 rupees. Suppose after 6 months he has planned to increase the total production to 100 units into 120 units with the same price. So 120 units into 20 rupees. So 2400 rupees will be the total production cost. So he has increased additional 20 units with the same price. So the additional 20 units into actual price rupees 20, which gives 400 rupees increase in the overall production. That change from 2000 rupees to 2400, the difference between the total production is called as marginal costing. So it is simply we can say like the change in total production cost that comes from making or producing one additional unit. I hope you are clear with what you mean by marginal cost. Now we can move to the significance. Why do we understand marginal costing? What is the use of knowing marginal costing? The first thing, when you know the marginal costing, it will be easy for the manufacturer or the businessman to decide various things like production, product mix, setting up prices, and whether to expand the business or not, like that. Then the second thing is marginal costing is very helpful in simplifies the process of cost accounting by separating variable cost from fixed cost. When we know how much is the variable cost and how much is the fixed cost, it will be easier for to understand the cost behavior of a particular product that we manufacture in a firm. So this is the main significance of marginal costing. Then marginal costing is very helpful in facilitating break-even analysis. What do you mean by break-even analysis? Break-even analysis means it is a point where the minimum level of sales is needed to cover all the costs. That point is called break-even. In that point, usually there will be no profit or no loss. So it is called as break-even analysis. This break-even analysis can be conducted only when we know the marginal costing. Then useful for short-term decision making. In business, we are pushed to make so many decisions in our day-to-day life. Some are short-term decisions, some may be long-term decisions. When we know the marginal costing process, we can easily take short-term decisions like where to focus, which thing to be changed. These are the things can be understood from marginal costing. So it will be helpful for taking short-term decisions. The next significance of marginal costing is to provide a basis for flexible budgeting. Usually, budgeting should always be flexible. It has to be adjusted with the production cost. When we know marginal costing procedure, we can easily make flexible budget. This marginal costing provides a basis for flexible budgeting, which is very helpful in adjusting the budgeted cost and revenues based on changes in the level of activity. So we have learnt about the significance. Now we are going to move to learn about limitations of marginal costing. Though we have discussed so many benefits of marginal costing, this marginal costing has some down points. We are going to see one by one. Some of the key limitations of marginal costings are overemphasis on short-term decision making. This marginal costing gives more emphasis on short-term decision making and it lose focus on long-term decisions. So it is considered as one of the drawback. And then marginal costing says that it is helpful in differentiating variable cost from fixed cost, but the thing is it is very difficult to distinguish between fixed and variable cost. And this marginal costing completely ignores inventory cost. It will not consider the inventory cost, so it is not acceptable in all cases. We have to focus on inventory cost too. Then limited use in pricing decisions. Marginal costing does not take into account the market conditions or competition when making pricing decisions, which can be important in situations where prices are key factor in determining demand. When we decide about demand, in most cases prices will be the key factor, but this marginal costing will not focus on the key factor price, so we can use only in limited areas. This marginal costing will not be suitable for service industries. It will be helpful only in product manufacturing, so this is considered as one of the down point. Then marginal costing will not give focus on qualitative factors like customer satisfaction, brand reputation, product quality, etc., as it focus only on quantitative factors like variable cost, production cost, marginal cost, etc. So these are all the down points of marginal costing. Though marginal costing is useful in many cases to take managerial decisions, it is vital to know its down points too. Thanks for listening.